We have the top past picks, rather, of David Burrows, president and chief investment strategist at Barometer Capital Management. June 4th, 2013, just over a year ago, you recommended Inter Pipeline wisely. You've held this for a long time, up by 41%. That includes the dividend. What more can you say? It just keeps going higher. The story's good.
You know, sometimes you get a leadership theme that has legs to it, and that's obviously we're looking for situations where there's some change taking place that leads to something better in the future. Pipelines historically over the last 50 years have been about the best industry for return on capital. And then you throw in the kind of volume growth you've had coming out of the oil sands over the last number of years, and Interpipe's had a great opportunity. So anybody who has infrastructure in these areas has a leg up on anybody else. To tuck in new capacity against a competitor who wants to come in and build a new network, you know, you've got a huge advantage. And so the opportunity to keep growing cash flow and dividends 5 to 10% a year probably extends out for another 5 years in the future. And what multiple do you pay for that predictability and that stream of cash flow, again, versus a fixed income world that's 2.5%?
Now, we get a lot of calls about the likes of Citigroup and Bank of America, but here's a best-in-breed U.S. bank. Wells Fargo, you recommended, higher by nearly a third in the last year.
Yeah, we've been of the view that Wells Fargo really is the best managed bank in the U.S., and it happens to be that they are firmly, you know, in the C&I or commercial industrial lending area and consumer lending, big in the mortgage business. But the thing is that they just have run this business beautifully. They're getting a great return on capital compared to their peers, and they don't have a big capital markets business that is a drag on so many other banks. So this is one that we continue to hold. It just chugs along. Financials are a beneficiary of the restructuring in the U.S. Their capital ratios are very good, and they'll have lots of opportunity to grow their dividend as we go forward over the next 3 years.
Dividend of 2.7%, still only trading at just under 13 times estimated earnings, despite that run in the stock. Now we're looking at Merck, MRK. Maybe you can talk first off about this Idenix deal in the hepatitis C area. Smallish for this size of company, but do you think it's important?
Well, the hepatitis market is a massive market, and there's a race going on. Merck has a good foothold in the space to begin with, but Idenix has a very good product. So they are solidifying their brand or their positioning in the hep C market. And again, it's a huge premium that they're paying, but relative to Merck's market cap at $120 billion, it's relatively small investment. $170 billion market cap. So we like pharmaceuticals. I think that there is a premium being put on companies with predictable cash flows and dividend growth, and Merck fits into that camp. The pharmaceuticals industry still is relatively underowned relative to other industries. After 12, 13 years of underperformance, we've had 2 years of pretty good performance. And they've got a big engine, and once they get it ramped up, it can generate lots of profitability, so we continue to hold this stock.
Past picks for David Burrows, Merck, Wells Fargo, and Inter Pipeline. We will take a short break here and come back with more of your questions on North American large caps.